Hello everyone! Today we're diving into one of the most fundamental concepts in finance, how to calculate the required rate of return using the Capital Asset Pricing Model, or CAPM. Now, don't worry, this might sound complicated at first, but I promise you'll be able to master it by the end of this session. And remember, if at any point you feel lost, take a deep breath. You've got this! Alright, let's start with the basics. The CAPM formula helps us determine the expected return on an investment based on its risk compared to the overall market. This is especially useful when we're trying to decide if an investment is worth the risk. The model combines the risk-free rate, the beta of the stock, which measures its volatility relative to the market, and the expected return of the market. Here's what we need to know. Risk-free rate, RF. This is the return on a risk-free investment, usually represented by government bonds. Beta. This measures how much the stock's price moves compared to the overall market. If beta is 1, the stock moves exactly with the market. If it's greater than 1, it's more volatile. If less than 1, it's less volatile. Expected market return, RM. This is the average return expected from the market as a whole. Now here's how we calculate the required rate of return using CAPM. The formula goes like this. The required rate of return equals the risk-free rate, plus the beta multiplied by the difference between the expected market return and the risk-free rate. Let's see it in action with a real-world example. Imagine we're analyzing a popular tech stock, say Teknova Inc. Here's what we have. The current risk-free rate, represented by a US Treasury bond, is 3%. Teknova Inc. has a beta of 1.5, indicating it's more volatile than the market. The expected return on the market is 8%. Now let's plug these numbers into the formula. Start with the risk-free rate, 3%. Next, the beta is 1.5. Finally, the market return is 8%. Let's substitute these values into the formula. First, calculate the spread between the market return and the risk-free rate. In average, the return of the market is 8%, while the risk-free rate is 3%. The spread is 5%, which is generally known as the market risk premium. In other words, investors require at least a 5% premium to depart from the safe haven provided by treasuries into the risky waters of equity. Next, we acknowledge that Teknova Inc. has a beta of 1.5, which means that when the market moves up by 1%, Teknova Inc. generally moves up by 1.5%. When the market moves down by 1%, Teknova Inc. generally moves down by 1.5%. Since the systematic risk of Teknova Inc. is roughly 1.5 times the risk of the market, investors require 1.5 times the premium they usually require to invest in the market. That is 1.5 times 5%, which equals 7.5%. Finally, keep in mind that this 7.5% is what investors require on top of the risk-free rate. So the actual total rate of return required by investors is 7.5% plus 3%, which equals 10.5%. So for Teknova Inc., we'd expect a required rate of return of 10.5%. This means that if the investment in Teknova doesn't offer at least a 10.5% return, it might not be worth the risk. See? Not so bad, right? You're already equipped to tackle any basic KPM calculation you come across. Remember, finance is a mix of logic and numbers, and you've just solved one of the most important equations in investing. You're doing great! Let's keep in touch.